Hi guys, it is YouTube video time. I told you guys I would do a video this week on wallet management. So let's go, let's rip into it. So you want to trade leverage. Let's start with the reality most leverage traders face. Most leverage traders do not lose because they're dumb. Most leverage traders lose because they're greedy, impulsive, emotionally fragile, and they treat their bank account balance like it's a slot machine that owes them money. Today, I'm going to walk you through how I manage my money and how I manage it against the fuckery that is the leverage market, and how I keep myself standing while making sure I don't take too big of a hit to my wallet balance. It's not about some magic indicator or some price level mumbo jumbo today. Today's all about wallet management, risk discipline, and how to slap the greed goblin in the mouth before it empties your entire wallet balance. If you don't get this part right, nothing else matters. You could have the cleanest entries in the world, but if your wallet's a mess and your risk appetite is unhinged, you are going to end up losing everything, rage quitting, and blaming the market makers for your poor discipline. At the end of the day, it boils down to how you manage your account balance. You don't want to dry up your wallet before you have the chance to be profitable. We're starting off with section 0 because before wallet management, it's building a bankroll. So section 0, how to build a bankroll / funding your future war chest. So before slicing up your wallet and assigning different percentages, you need to build a fucking wallet to begin with. Here's the truth. If you're spending your rent money in the leverage market or going into debt to try to chase a trade, you already lost, homie. Trading isn't about luck. It's about having the capital long enough to learn the skill of trading. So how do you build a bankroll? You start by saving 20% of all your disposable income for 1 year. Any disposable income, 20% of it goes off to the side. That means cutting out expenses, live frugally, live below your means, and treating this capital preservation like a skill and not a chore. This fund becomes your launch pad. It becomes your nest egg. It becomes your future bankroll. So don't rush this phase. Just by sticking to the savings routine, you're strengthening that discipline muscle. Once you have that stack built, you can now use proper risk management strategies, and we're going to get into that right now. So this takes us on to our first section, Wallet Management 101, Protect the Core. The first portion is wallet allocation and separating the tools. Your entire wallet balance is not your piggy bank, it is not your emergency fund, and it is not your get rich in one trade ticket. That's how you make a donation to the market makers. Your bankroll is your operational bottom line. So treat it like a business and not like you're gambling at a roulette table in Vegas. You need to build a financial firewall between the functions in your trading life. Why? Because humans are emotional wrecks, and when all our money is in one place, we tend to get sloppy. Every trade feels like life or death, and that kind of money sitting in one spot makes you sloppy, impulsive, and it makes you greedy. It makes you stupid. When you separate your capital into distinct stacks, each with its own risk tolerance, you gain control. You remove emotion. You make decisions based off logic, planning, and not panic. You create a battlefield where you know which troops you're willing to sacrifice and which ones you're going to guard with your life. This takes us into section 1.2, which is how to divide our bankroll. So I think about it this way. I have my main capital reserve, which is 70 to 80%. This is not to be touched. This is our core capital. This is to be protected at all costs. Do not YOLO with this. Do not scalp with this. This is your long-term protection against ruin. It sits in cold storage or on stables. Your core capital, protect your core capital. Remember, trading crypto is trading a constant mindfuck. So not touching this portion will always keep you afloat. Then we go to our active trading stack, which is 15 to 20% of our capital. This is the stack you use for day trading, swing setups, longer setups. This is your ammo pouch, not your entire arsenal. You use this portion to create larger wealth. If you can't turn 10% into 100%, you're never going to turn 100% into anything. We'll go into that into the next portion. But for now, you should be thinking about this stack, this 15 to 20%, as your active trading purse. Then we go on to our high risk slash experimental wallet, which is like either 1 to 5% of the wallet. This is a very small portion you use for speculative trades, highly speculative trades. Think volatile altcoins, early stage projects, aggressive setups, where the probability of loss is very high. These are calculated gambles, not reckless bets. So if it goes to zero, it was expected and accounted for. But be warned, this allocation should be approached with curiosity and discipline, not desperation. Why do we do this? Because if we separate our wallet into different allocations, it creates clarity and control. When everything's lumped up into one wallet, it creates over trading and you get more emotional with every move. But when it's segmented, you treat each wallet with a role, just like a general treats every soldier on a battlefield according to their roles. You're going to treat each fund different according to its allocation. And this brings us to section number 2, which is risk management and never letting a trade control you. The first portion of this is the 1 to 2% rule, meaning you never risk more than 1 to 2% of your active trading wallet per trade. This does not refer to how large your position is overall. It also refers to how much money you stand to lose if your stop losses get triggered or you get liquidated. Let's just say you have $10,000 in your active trading wallet. You're only risking $100 to $200 max per trade. That means you can survive 50 to 100 trades before getting smoked. You can take 50 to 100 L's before getting smoked. Does that mean you're going to lose 100 times in a row? Probably not. But if you have this rule, you can survive 100 trades. If you don't have this rule, you're going to blow it in 3 trades because you have an emotional setup. That takes us into our second portion, which is stop losses. They are not for the weak. Stop losses are discipline tools. You're not a samurai honor dying every time you open a position. You're not a captain that has to go down with his ship. Stop losses are your best friend. Adults use stop losses. Stop losses protect us from ourselves. So don't fall in love with a position, and if it goes a wrong way, stop loss yourself out of it and plan a new one. If your stop is too tight and you keep on getting wicked out, you're either over leveraged on that coin or you're planning the wrong position. Take a step back, realign with confluence, structure, and volume. That's your edge, not blind hope. Keep an eye out for my next video on how I approach the market and taking a trade. But next, we're going to go into my next section, which is greed management. So this takes us along to section 3, greed management, the real boss fight. The first portion is the wallet goblin, and he lives in our head. You know the voice in your head that says, just one more trade? This could double your account. What if this is the trade that changes everything? That's the wallet goblin. And if you listen to it, you're going to end up with a 0 account balance and an empty treasure. So the point is, you do not need to win big. You need to learn how to win long. Greed speeds things up, and if you get greedy and things go fast, you lose really, really fast. So the point is to not try to flip your stack as fast as possible. It's about whether you're still standing the next cycle, and the point is to consistently build profitable habits before smacking down fat positions. Remember, you get rich slow and you go broke really fast. The second portion we're going to move on to is paying yourself and acting like a real business. Every win, skim a chunk off the top, 10 to 30%, pull that shit out of the exchange, pay yourself, treat it like a payroll. Would a business reinvest 100% of its profits right back every day into the business without any savings or withdrawals? Hell no, that's fucking psychotic. Most traders do that though. Don't be most traders. So the third is big wins. The second you nail a massive move, I'm talking about 10x your money, the kind that makes your eyes like, oh, you need to learn how to like exit, chill, log off, go touch some grass. If you must, leave a runner, but pay yourself. Big wins distort your brain chemistry. They get you cocky and you lose respect for risk management. And the market punishes that 100% of the time. After big wins, you are super vulnerable. So treat big profits like a red flag and secure portions of the position by sending it out, whether that be to your bank account, cold wallet, and then go decompress. Taking profit can be just as stressful as taking a trade. So keep that in mind. Don't overdo it. Now rolling on to section 4, which is ego, emotions, and delusion, the trinity of death. This first portion is about ego. Ego is the killer. Guys, you are not smarter than the market. You do not deserve to win. The second you think you have everything figured out, you are one candle away from ruin. The market makers are the equalizer in this market, and they will swing the volume on you when you least expect it. You are plankton at the mercy of the whales, so try riding their currents instead of getting caught in their mouths. This next portion is about revenge trading and how revenge trading equals financial ruin. If you take a loss and your first instinct is to jump right back in, close the chart and log out. You're in an emotional tilt. You're not strategically trading. The best traders don't trade when they're losing. They back off and wait for their setup to form. This third portion is about FOMO, how FOMO is for the sheep. If you missed a move, so what? There's always another one. Jumping in late is how you become exit liquidity. You need to train your brain to associate FOMO with danger, not opportunity. If you feel FOMO, you already missed the move. The market is designed to work off your fear of missing out, so don't give in to it. All right, our last and final section of the day is section 5, how to build a strategy and trading with a plan. First, you need to set up an entry checklist. For me, it's price levels on higher time frames, volume, stochastic RSI and RSI confluence, Watson breaks, Kiltner zones, trend confirmations. For me, that's how when all those things come together, I understand that it's time for me to lock in. For everybody else, it might be different things, but understand to find your sweet spot and stick to it. Secondly, it's have a take profit ladder, not just one target, but multiple targets. TP1 meaning like take a little bit just in case you get stopped out by fees. TP2 is enough to secure your initial. Remember, we protect our core. So if you can take out enough to protect how much you put in, you're able to essentially play with a free position. Then your TP3 is your greed check. This is where you're going to decide whether to close fully or close 80 to 90% and leave a runner. If you enter a position, you have to know where you're going to take profit in the beginning, or else you're just going to end up riding a ladder. You're going to get stop loss, or even worse, you're going to get liquidated. And finally is setting time limits per session. If you are forcing trades after 2 or 3 hours of staring at candles, you're cooked, buddy. You're fucking cooked. All right, it's not working out after 3 attempts. Take a break, go do something else. Come back to the charts later when your mind is fresh. The market's going nowhere, so don't bankrupt yourself trying to force a trade. Let the trade come to you. Your system is your anchor. Without it, you're just another emotionally fragile LARPer with access to leverage. If you win, take profit, secure the profit, and if the position goes south, know how to have an exit strategy. If you do this, you can do it over and over and over and over and over again. That's kind of the point. So basically, our final takeaways for the day are wallet management. Know how much of your entire bankroll you are willing to risk, and stick to average bet sizes. If you don't, you're gonna go broke really fast. Risk control, set a solid stop loss and a take profit system. If you do this consistently, you will win. And greed suppression, basically knowing when you're gonna have to hold them or fold them, because you don't know if the market's not going your way, and you don't want to have to be too greedy or hold on to something for dear life because you think it's gonna go your way. These aren't just tips, these are survival mandates because the market does not care about your feelings. It doesn't owe you anything, and it sure as fuck won't save you from yourself. So protect your wallet, pay yourself, cap your risk, and starve your wallet, Goblin. And when in doubt, walk away from the market before it teaches you the lesson restraint would have spared you. If you like this video, like it. If you didn't, dislike it. I don't give a fuck. Join, subscribe, follow the Discord. It is free. It doesn't cost you anything. Daily market updates. You get alerts when I go live on Twitch. It has the best VC chat out of every Discord I've ever been in. We have the most active traders who actively trade. So come on through to the Biscuit box. Maybe you might learn a thing or two. All right. Thank you. I'll see you guys later. Bye.